Greetings and salutations, as I've come to say quite often. I would like to welcome you to a special edition of Down the Middle. Today we celebrate the 1-year anniversary of the show by getting back to California. Haven't been here since. And visiting with our very first guest, Jeffrey Gundlach, the founder of DoubleLine. I can't be any more pleased to be here with you today in your home. I can't believe it's been a year.
Yeah, I remember recording it. I think it was in July.
It was in late July, July 31st.
It was hot as Dickens.
It was really hot.
It was like 105 degrees.
Mm-hmm. It was.
And weirdly, it's an unusually warm day today.
Well, every time I come from Texas, I bring the weather with me. So I do my best. So, well, back then, COVID was raging.
Yeah.
And now COVID is raging.
Ish, yeah.
Ish. It's, well, hospitalizations or whatever they are, 2/3 of what they were at their peak, but they're still there.
Yeah.
Tell me about how COVID has changed you as a person, because we've all been transformed by this in some way, shape, or form. I've spent a lot more time with my children than I would have otherwise, and they've learned how to exist around mom always writing, and it's been great. But COVID's changed all of us in some way. How's it changed you?
I'm probably reading more than I used to. I've got a lot. It's weird. It's actually working seems to be in some ways an increase in productivity working from home, especially in Southern California, where you can have, some people have over a 2-hour round trip commute. When you think about that, that's one day of the week, actually, times 5 is 10 hours, right? So it's basically one working day that's stolen from you. And I eat lunch in about 3 minutes at home too. So if you go out, I never really went out much for lunch, but when I did, it takes like 45 minutes to an hour. So there's another hour that's gone away. But I started reading 1984, the George Orwell book.
Now?
I started reading it, yeah, and it's very difficult. It's just too close to the bone what you're reading. I can only read like a couple of chapters, and then it's like I just got to take a shower or something. It's just so brutally predictive. He wrote that book in 1948, so he predicted that it was going to happen pretty quickly.
Yep, and
it did happen fairly quickly, but. Guy was pretty accurate. I also reread Looking Backward, the Edward Bellamy book that was actually one of the biggest bestsellers of the second half of the 19th century. And that was predictive too of the future. It was predictive of a utopian society where the government controlled everything. So it's kind of maybe that inspired Orwell, who knows? But it's interesting. I typically don't read fiction ever, because I feel like I could make it up myself. But these aren't really exactly fiction books. They're more of prehistory prediction books.
So what has our government done right? What's our government done wrong? As it pertains to COVID, because that could be a pretty broad question. Yeah, we'll get there later, I promise.
Well, I think so far what may be right, because we don't know what the long-term consequences of vaccines are going to be. But clearly what President Trump did when everybody laughed at him, criticized him for doing Operation Warp Speed,
right.
Said it was reckless, said it was impossible that we could get them rolled out. Now, if you give Big Pharma enough incentive, a lot of things can happen. I kind of notice that Big Pharma has they have a real jackpot on their hands here. If you need boosters every 6 months, the profits are unbelievable. I saw statistics that if you take 10 of these big pharma companies, the heads of them have made billions and billions of dollars personally. So I think the vaccine rollout has to be viewed, at least so far, as positive. It turns out that it was reckless to do it because of side effects or long-term problems. Then maybe people will rethink that, but that was right. I think the initial approach to distancing and barrier doing, I thought that was foolish. I thought it was fairly clear that these types of things are not going to be contacted from surfaces, but rather through the air. And we went to a lot of pains to put up. We enriched a lot of plexiglass makers. I know we bought a whole regime of that stuff for the office.
Right.
I don't even know if it's up. I haven't been in the office for a few months now. I've probably been there about 6 times since we did work from home. So, you can't really criticize who knew exactly, but it was one of these things where we kind of went understandably overboard in precautions. I think the outdoor stuff was wrong.
I can't tell you how the rest of the country viewed outdoor dining in Los Angeles being outlawed. I had to read that headline over and over and over again.
If you want to talk about something that was done wrong, it has to do with a lot of things on the local level. Like there was a sort of mini scandal where there was this restaurant owner who put all this money into building outdoor dining. And you remember, they actually put a ban on outdoor dining.
Yes.
We're talking about. And so she was livid because there was a movie production company that right next to her outdoor dining patio set up a big catering tent for some sort of TV or movie shooting. So it reveals the way local decisions are made, which has a lot to do with who you know and cronyism. And you get to see kind of the dark side. It was like Gavin Newsom going to the French Laundry when he had you can't go to restaurant owner. It was Nancy Pelosi getting her hair done when nobody else could. All that stuff I think was done wrong, but it's not because of COVID. It's because that kind of stuff is always going on.
Sure.
It just gets revealed. So that's kind of what I think. I think what the government did with regards to spending blindly obviously had a very substantial fraction that was corruption, that was wasted. California admits that tens of billions of dollars are unaccounted for, just kind of gone.
Amazing.
So there was a lot of arbitrary stuff, but that's kind of the way it always works. So I think the biggest mistake relative to COVID, and I know this is a politically sensitive topic, but I think the southern border allowing in over 2 million people illegally, and almost like with open arms welcoming them in illegally. And obviously some of them have COVID. That obviously wasn't a very good idea, but the whole treatment of that issue has been frustrating and disturbing. So I don't think that was a good idea. But there's a whole bunch of things. The first day, I think Biden shut down the pipeline, which costed jobs, tens of thousands of jobs, and the price of energy went up massively. Not solely due to that, but obviously in part due to that. So we have the inflation. We have war.
Let's hold off on the war, but let's focus on inflation, because if you recall, both of us, we had modest means when we were growing up.
Yeah.
And, I look at the effect of the necessities of life, and you talk about consequences, because I won't call them unintended at this point. But when you talk about rental inflation and home price inflation, and how that's affected not even low-income Americans, because low-income Americans are in many ways covered, but how it's affected the middle-income earners in this country.
I think we haven't even gotten to chapter, halfway through the book on the shelter inflation, because my theory is that once the eviction moratorium ends, I think you are going to see a lot of evictions. A lot of people just aren't going to pay their back rent. And I think they're going to get evicted, or else just say, hey, who even cares? I've been living rent-free for a year and a half, and what the hell? I'm not going to pay that back. I'll just go across the street. Well, I've got news for you. Rents are going to go way up, I think, because if you're a property operator, you're going to say, there's a chance that we go back into a moratorium on evictions. And if that's the case, I've got to, price that in. to my
Well, there's something to be said for the rule of law.
Yeah, so they're going to say, well, if I'm charging $100 in rent, I think there's I don't know, it'll vary by assessment, but I think there's going to be a 25% chance that I could lose another year of rent. So I'm going to raise my rents 10 or 20, 30%.
Just in case.
And obviously, there's a leading indicator of rent is home prices. And home prices are up 23% year over year.
Astounding.
And I'm not sure that's exactly the statistics. Almost all the statistics that we look at in the post-lockdown, after the advent of the lockdown, are kind of skewed by mixed shifts and all kinds of bulges and potholes.
Well, high-end housing has certainly been in the lead of home price appreciation.
It's not, the mix has shifted. There's been a lot more activity at the middle and upper middle end. So there's a little bit of murkiness in the numbers, but 23%. And one thing that's not murky is there are plenty of metropolitan statistical areas that are up clearly 20, 30, and even 40%.
Well, but in the state we're in right now, since 1850, you've never had a net contraction in your population, and yet you did in 2020. And let me tell you, I know they're in Boise, Idaho. I know for a fact they're in Texas. They're all over Texas.
Well, I can tell you all about it. I traveled to many states looking for property because, frankly, I'm bullish and have been bullish for the past couple of years on certain types of real estate, residential real estate, and not in the areas that are hot, like Austin and Nashville. Sure. You mentioned Boise. I'm looking for the places that are much cheaper because they don't have this kind of herding mentality. So I looked at property in New Mexico, Arizona, Wyoming, Colorado, Idaho, and then ultimately ended up buying a property in Alabama, of all places.
You had to keep going east.
Well, a lot of that was due to the fact that my brother-in-law lives in Alabama, and he found this property. It was never officially listed. And so I thought it was really, really cheap. But yeah, I mean, everywhere you go, all you hear is herd. I think it's turned, but there was no supply, and there was tremendous demand. And so I was actually looking in Wyoming, Colorado. I had this idea of a ranch, which I soured on after a couple of months of looking at it because they're too remote and they're just too hard to take care of.
Sure.
But they were selling like crazy. I would call up a guy who had a listing, and he'd say, usually if you call them up, you call a real estate agent, they're back to you within 3 minutes. They got a fish on the hook, right? And they want to reel them in. But I didn't get called back for like a day, 2 days from these, and they all said exactly the same thing. That is, I thought last year was a good year. This year is multiples.
Gangbusters.
I think I have never worked so hard in my life. And the properties that were good, another reason I soured on the ranch concept, the ones that were good, where they actually had good improvements, that's usually a problem. I would call up and they'd say, it's under contract.
Yeah.
And it was listed like 2 days earlier, under contract. And so, yeah, it's clear that those prices exploded. I have a house in Buffalo, New York, and I bought it in November of 2017. And boy, that was good timing. I didn't buy that as an investment, but I think it's probably worth more than double what I paid for it. My nephew lives there in the suburbs, and he told me that 3 years ago he would have been very happy to sell his house for $125,000. And he thinks he's going to get close to $300,000.
So speak to me about how this episode, therefore, is going to impact income inequality in America.
It has changed income inequality in a way that has greatly enriched the uber rich, I think. You look at what's happened to like Amazon's world, and Facebook and Twitter and all that sort of stuff. And I think it may have temporarily helped out the very, very low end, but I think we just continue to hollow out the middle. I think money giveaways have historical precedent, and basically what happens when you get deeper into the money giveaways is there's so much shortages, which are obviously apparent today, and there's so much inflation at certain places, that what happens is that the people who were at the lower end prior to the money giveaways actually get into abject poverty. That's happened pretty much every time.
Well, that's
the ones
the
in the
thing.
middle become poor.
Right.
And the ones that really do well are those that are close to the levers of money printing. They make sure they get an extra dose one way or another, either through an extra check or under the table or through the economic consequences. So, that's what ended up causing ultimately the French Revolution.
Well, I was going to say, I mean, I'm jumping the gun here in terms of coming to conclusions, but how does this, I mean, what does this imply for the future of the United States? I mean, how do we turn off the spigot? How do we unplug people we've been covering their major expenses for since April of 2020 with the passage of the CARES Act?
We've got a tiger by the tail. And initially people thought, well, we had no option because we were going to get mauled by the tiger. And now we've got tiger by the tail is a funny expression. I don't think it's really going to stop you from being mauled. But it gives you the sense that you're temporarily safe. And it's going to be interesting once we let go. Can we let go of the tail?
Of the tail.
Because it's obvious that we had momentous shifts based upon these policies, and getting out of them will not be smooth. It will have to be shifts. We already talked briefly about rent inflation, which of course means that inflation broadly is either presently understated or is about to be either revealed or continues to be understated. That owner's equivalent rent really sticks out because that's a very big component.
And it's not transitory.
It's never transitory of the CPI. That's a big component of CPI. And I don't know what the most recent data point was, but it's been at around 2.5% year over year. Housing prices are up 23%, and rents are up more than 2-something%, and they're about to go a lot higher. If you used, and this is overly simplistic, but it's telling, if you use 23% as the shelter component of CPI would be over 11% on the headline right now. And it would be way higher on the core because the shelter is also involved there. And so there's going to be those types of consequences. And
people are feeling that. I mean, that's people's reality today in many cases. I mean, whether you're talking about apartment REITs or single family rentals, when they're turning these new leases, they're seeing just huge numbers.
There's going to be huge increases on turning leases. I think it's already running. It's all dependent upon specific circumstance, but still, it's already running double digit.
So,
and the Campbell Soup Index, which is really a funny index, it's good because it goes back to the 1800s when they started Campbell Soup.
Yep.
And it's just what's the cost of one can of tomato soup? I don't know what flavor they use, but I think they're all the same price. I don't even know. But Campbell Soup Index is obviously a parabola going back to the inception, but the most recent data point was a year ago, and it was 85 cents a can. Today it's $1. So there you go. I've also have other anecdotal evidence that this is not transitory, and that has to do with the cost of hiring workers. And I'm talking about the pool guy, the gardener, somebody to come over. And I had a water problem in one of the bathrooms. I had to try to get a guy to come over and do some touch up. And he said, he's done a lot of work for me. So he's gave me an audience even. And he said, I have 3 years of work. And I mentioned going around all these different places. Everywhere I went, and I'm sure everyone can verify this, everywhere people say, I can't get workers. I'm competing with the government. You see signs. I saw a sign in an In-N-Out Burger yesterday, now hiring $18 an hour. I went you go to places, there's a great hot dog chain in Buffalo. It's called Ted's Hot Dogs. It was founded like in 1928.
Yep. And
they've expanded, and they've got, I don't even know how many locations now, probably a dozen. And we went to the one that we always go to, and there's a sign that says, location closed. Can't get workers. And then they have a list at another one. About half of them are closed, the other ones have workers, and they're open 11 a.m. to 4 p.m. because that's all they can hire. Now hiring all locations, all shifts, part-time, full-time.
Yep. It doesn't matter. I'll add your anecdotes. It doesn't matter what caliber of hotel you're checking into. They're telling you at check-in that there's no cleaning service.
Really? I
woke up this morning here in Santa Monica and I made my bed.
I went to this high-end restaurant. I'm friends with the owner, and I couldn't believe it. It used to be that the little ribeye was $50. Now it's $80. And I said, Hutch, when are you going to put the price back down? He said, I'm never putting the price back down.
Never. How's never work?
Yeah, never's a long time. And so there's all kinds of that stuff going on.
So let's go back to prior to the pandemic. Let's go back to 2018. And Jay Powell is something of a rookie. Credit spreads start to widen after the debt of General Electric is downgraded.
Yeah.
And they stayed up. They stayed up all the way through not QE. They remained elevated all the way up until the advent of COVID landing on American shores.
Yeah.
And we obviously had problems in the plumbing. World trade contracted for the full year of 2019. That's never occurred without the U.S. falling into recession.
Yeah, there were a lot of indicators that were saying that recession was getting more likely.
Right.
The leading indicators turned negative before COVID came. That type of thing. The spread between consumers' view of the present, which was very lofty, and the view of the future, which was prescient.
Right.
That was looking.
So there were signposts, but what I'm getting at is the Fed had to increasingly deploy more and more liquidity and not call it QE. They were really careful to call it not QE and distinguish.
When
and it
the
was
money markets froze up, for example,
right.
That was a real canary in the coal mine. We talked about that at the time. It's like weird things are starting to happen here, and that a little bit of that seems like it's happening now.
Well, that's what I'm getting to. So, but if you look at the aftermath of the financial crisis, the Fed was enough on its own. Quantitative easing was enough on its own.
Yeah.
You look at this aftermath, and you had to have a double-barreled approach. You had to have the monetary and the fiscal. Both. Right. I mean, if I read correctly from a St. Louis Fed paper, since the CARES Act, we've injected 43.2% of GDP over the span of stimulus, more than the New Deal.
Yeah, sure. Every time we have a recession, going back about 25 years or something like that, we add some other, weapon to the arsenal. And we all keep using the old ones, but we always need a new one. And every time it happens, we say, can you believe that it's come to this? And remember people thinking that the quantitative easing back in the aftermath of the global financial crisis, that was outrageous.
Yep.
And now,
I remember when AIG
now
85 billion was like, wow.
Fiscal, I just call it the explosion of the deficit. Last year's GDP officially, real GDP was -2. And this year they're talking real GDP of about 6, some of which is inflation. No, that's a real GDP, but they don't have inflation rate. Anyway, let's just say that's accept the numbers. So for the time period, no, it was -3.5, I think, last year, if I'm remembering right now. The point is that we're only up about 2% for 2020 and 2021, based upon the estimates
for all that money that was spent.
Right. So we spent,
and it wasn't invested, mind you; it was spent.
It was just given away, a lot of it, or else, or corruption ate it up.
Right.
But I mean, I've lost track. You probably have the number at your fingertips, but the total, just the giveaways, forget about anything else. Is it 6 trillion? I can't remember, but let's just say it's
closer to 7. But yes.
Okay, close to 7. Well, that right there is 30% of GDP.
Unbelievable.
Right? And we got, for 30% of GDP expansion of the budget deficit, we got 2% real growth.
Before we go to where we are today, I want to ask you a question in your wheelhouse. kind of brass tacks. So Jay Powell came out with unheard of levels of quantitative easing. I mean, the Fed was just buying. I mean, there were days that the Fed bought $100 billion, grew its balance sheet by 100 billion in one day. I mean, I remember being a spectator, going, you got to be kidding me. Mm-hmm. Did Jay Powell also have to bail out the corporate bond market?
Yes.
Why?
Because it was completely dysfunctional. The amount of sellers was overwhelming the amount of buyers. People were pulling money out of those types of funds, mm-hmm. and they had to be liquidated. And so
I'm speaking prior to COVID, by the way.
Oh.
I'm speaking, when he came out March the 23rd, he grandfathered in triple Bs. Did that have to be done?
Well, no, it doesn't have to be done. But it was kind of like the way that we did things with social distancing. They erred on the side of, I guess I would call it, a twisted form of caution. And there was a real fear. There was, I've got to tell you, I've lived through a lot of stuff. I've been at this almost 40 years, mm-hmm. and I've lived through a lot of these. The sentiment and the panic that was in the credit markets, corporate credit included, was at a level that I've never seen before. There was actual reporting back to me from some of my investment teams that in certain sectors, the bid was zero. There was no bid. And there was actually moments where there was no bid on some treasuries.
That is correct.
So
in Asian trading, I remember.
They didn't have to do it. There would have been incredible amounts of downgrades and bankruptcies if they didn't.
Would that have been a bad thing?
No, it wouldn't have been. It's a question of short term versus long term. In the short term, I guess it was a good thing to do it, but in the long term, you need credit cycles to cleanse,
to cycle through.
Yeah, you need credit cycles so that you can get rid of the zombies, mm-hmm. get rid of the inefficient companies, and it doesn't happen. And a lot of people argue, that's one of the things that's fueled deflation is excessive supply of stuff, and there's some logic to that. But when you give out this much money, the consumer's wherewithal overcomes, the disinflationary forces.
True.
So I'm just disgusted, frankly, and I've said this before. I'm just disgusted that the Federal Reserve is operating in shameless violation of the Federal Reserve Act of 1913.
The Federal Reserve is mandated to make policy in the public interest. That's in the very top paragraph of the homepage of the Federal Reserve System, in the public interest.
Yeah, that's open to interpretation, I suppose.
Well, depends on which public you're talking about, the 1% or the rest.
Right.
So I'm starting to see evidence of a little bit, we're triple C's that are the riskiest sector.
Starting to widen a little bit.
We're up 80 basis points.
Markets have widened a little bit. Now, part of that's because treasury rates have risen, mm-hmm. I think.
A little bit.
Yeah.
But you see, covenant lights now are 90% for leverage loans. Leverage loans now are 90% of them have very little investor protections. Prior to COVID, it was 80%. So we've kind of ramped that up. I was watching an interview a few days ago with a private debt manager saying that private debt, some of the private debt that's out there, which is over $1 trillion now, is covenant light. I said, what? I said, sure. I turned up the volume and I rewound it. And I said, he did. No. In February of 2020, we had $10 trillion outstanding in corporate bonds. Now we're tracking to get to 12 trillion by the end of 2021, based on the run rate of issuance. Where are we going with this?
Well, the one thing with the junk bond market in particular,
which is $3 trillion now.
It's very big and the spreads are tight. I'll say one thing in support of the junk bond market, and that is the credit quality of it is better than it has been typically in the past of the junk bond market. Because of all the refinancings, mm-hmm. the balance sheets are pretty strong compared to history. And also, a lot of the junk bond market has been populated with some downgrades of investment grade.
True.
Now, the investment grade market.
That was my next question. Where does that leave the investment grade market?
That's not in such great shape.
Yeah, I use air quotes.
They're though still. I mean, the refinancing has been enormous in the corporate bond market, and that helps.
But the debt itself hasn't been whittled down.
Oh no, certainly not.
It's grown.
Oh, of course.
It's bigger.
Of course, it's grown. Yeah. So, the corporate bond market is extremely low yielding on just an absolute basis. The entire bond market is extremely low yielding just on an absolute basis. The junk bond market, to no defaults today, yields 4.0. The CPI is
and that's not adjusted for inflation.
The CPI is at 5.4, and it's probably understated. So you have negative real rates in the junk bond market. It's just, I think that's probably a first. Negative real rates in the junk bond market.
So let's just play a hypothetical, because you're reading 1984, not me. You're braver than I am. We have a few things going on in Washington, D.C. right now.
Yeah.
There are very few people who are paying attention to the debt limit at all.
Well, they're going to raise the debt limit. I frankly don't really pay attention to it because I know they're going to raise it.
So in 2013, Ben Bernanke was given a blueprint. He was given a roadmap on how the government could strategically default on Fed holdings of bonds, such that there was really no harm, no foul, because you were keeping it in the family. Do you think that given the stakes, 1 seat in the Senate, 3 seats in the House of Representatives, do you not think that one party over another is incentivized to use this to play serious hardball? I mean, we've just spent an inordinate amount of money in Afghanistan.
Yeah.
And the government's...
And there's going to be more in Afghanistan.
Well, the government's cash balance started off at $300 billion going into this. And then they extended the rental eviction moratorium through October. So all I'm saying is the cash burn rate is higher than what it would otherwise have been absent the extension of yet another safety net and Afghanistan. But if you're Mitch McConnell, what is your incentive to play ball, to raise the debt ceiling in order to facilitate $3.5 trillion to expand the social safety net by soaking the rich, theoretically, which always ends up getting middle income earners tax-wise, and raising corporate taxes and buying votes of progressives? What's your incentive to go along? I'm just asking a hypothetical.
Your only incentive is that to not raise the debt limit.
By $7 trillion?
It's almost sacrilegious to not.
That's what Janet Yellen says.
Yeah, I know. I'm not saying I believe that. I'm saying that's the way the politicians think. And so that's going to get raised. The real question is going to be what happens after the midterms, because I think as a base case, it seems to me that things can change, but as a base case, because we're more than a year out, but as a base case, you're going to see a huge loss of Democratic seats in the House of Representatives, I think, because one of the things that's underneath the surface here is that people are getting angry at the local level. They're angry at the teachers' unions and the school stuff, right? They're angry at the lockdowns. They're angry, and what makes them more angry is when the local decisions are made in accordance with largely the wishes of that local community, and then they get reversed out of Washington, D.C. And so that makes people want to get rid of the bums who are at the local level, which is the Congress of men and women. And so I think the way they express the anger of their local decisions being upstream to Washington, who reverses what they want, the consequence of that is going to be voting out a lot of people. So we're not going to have this sort of 50-50 Senate, which they are able to get things done, do everything on reconciliation, it seems. And they got a little bit of the edge in the House is going to go away. The Senate, I'm not sure, because that's less of a local level. But that's going to change. And so I think the Democratic leadership knows that that's a serious risk. And so they're going to want to get every possible thing done if they can before the midterms. And so that's why they're sprinting as fast as they can to get this stuff through. But yeah, I see that being one of the biggest problems is that it's pass it now and figure it out later so that you can get a piggy bank of this $3.5 trillion is the one that might be the one that breaks the camel's back, because it's just completely like undefined and doesn't seem to have any real purpose other than a slush fund.
Right. So with that in mind, and we'll agree to disagree about the debt limit, because I think that I think the Republicans have a real weapon to carry them into the midterms. But we're both coming to the same conclusion after the midterms, which brings me to my question. Can the Fed go it alone?
No.
Let's just say that we're starting to see rumblings in the credit market, and nothing's going to happen overnight, but we're starting to see a little bit of risk aversion pop into the credit market. So if you're talking about a change of leadership,
a little bit like the widening in the fall of 2018.
A little bit
at this point.
Mm-hmm.
And the way that the damage occurs, it's like in the Sun Also Rises. There's this thing. How did you go bankrupt? Bill asked. And it's like first slowly, then all at once.
I don't see necessarily a fiscal bailout of the magnitude that we've just seen. I don't see it repeated.
If you repeated it, you would have serious inflation problems. I mean, serious inflation problems if you repeated that.
Mm-hmm.
The first stimulus was largely pay down debt and save, because people had no clarity of the future. They were scared to death.
True.
They thought they might lose their job. The second one had largely the same characteristic, but the third one started to get spent.
Mm-hmm.
Because people are now starting to factor into their financial management, that this is going to continue. And if it's going to continue, well, then you can spend it. Or if you've paid down your debt. I mean, one thing that's fascinating about all of this is when the pandemic started, the things that were most at risk and most people were most fearful of were like credit card receivables, airline leases, and all that.
The household debt cycle, the credit cycle.
But household finances, in terms of delinquencies on credit cards, they've never been lower. Right? So if you took this stuff away, it would have all kinds of negative, GDP type of economic consequences. Just to start with, your deficit would be smaller. And that would turn the positive in GDP into a negative in the delta for GDP. So like I said, got a tiger by the tail. And people have made this analogy, and it is almost like eerie, the similarity between, turned out getting out of Afghanistan wasn't so easy after all. Now, maybe we didn't do it in an optimal way, so you could make the argument that it didn't have to be as messy as it is. But it's sort of like getting out of this isn't going to be easy. It's so strange how they're contemporaneous with each other.
So let's shift gears for a second to what's happening on the ground in the economy. When you start to see that car sales on a unit basis are going to decline for a fourth sequential month, 500,000 units, 4 months in a row. I mean, car lots are not empty. There are cars. And retail sales look like they're slowing. The home market looks like it's turning.
It's just too expensive now for most people. If you took the stimulus away, the housing market would have serious problems.
So people talk a lot about the fiscal cliff, but very few people are talking about the demand cliff.
Right. The thing is, you mentioned the housing market. Back in April, which I think was the peak.
It was the peak.
Market, there was nothing for sale. There were regions where there were 3 times as many real estate agents as there were listings, which sounds bad if you're a real estate agent. And inventories, got down to the lowest ever. They're still really low,
right?
But they're rising.
Mm-hmm.
I was in Buffalo. I always am wary of these types of anecdotal things being extrapolated, but I think this one, it's valid. I was in Buffalo in April, and I did not see a single for sale sign. There wasn't one. There were some sold signs, but there were no for sale signs. I was back there in July, and there were a lot of signs because the prices are high compared to what people think about.
Right.
And you look at the affordability indices, and they're pretty close to the levels that some of the highest levels in terms of lack of affordability than you've seen. And the old adage, which has some truth to it, is the cure for high prices is high prices. And you're getting pushback. The surveys that say, is this a good time to buy a house or a car? It's at sort of one of the worst levels ever.
It's at a 40-year low.
No, it's not a good time.
Yep.
And that's how people feel. So, I think the housing market sort of peaked out. It's at a high level. I'm not so sure it has to decline as long as interest rates. See, you said, you talked about, can the Fed go it alone and all this stuff? Can we do one more of these things? The real question is, when and if ever, will the Fed allow the free market to set interest rates? Because that doesn't seem to be happening right now. I can't imagine why somebody would want to buy a junk bond with a yield below the inflation rate. And that's obviously predicated on the Fed being at zero for
forever.
For who knows, as far as the eye can see. And I think they've been stealthily doing yield curve control. It seems that they've been extending the maturities of the quantitative easing. So it looks to me like we had the 30-year Treasury bond got up to 2.5 yield back in March. And now it seems to not want to go above 2.
Yeah, it's hit a ceiling.
It'll go above 2 for 5 minutes intraday, and it'll close at 198. And
you don't believe in coincidences?
Yeah, and it's about 187, I think, right now. And it seems like they're trying to cap it around 2%. And the one thing that's a funny conclusion of all of this is that as incredibly high as the stock market is on a historical valuation basis, using PE or Dr. Shiller's CAPE ratio, price to book, whatever have you, it's actually below average valuation versus Treasury bonds. Shocking as that is, one of the highest P's of all time, and it's actually below average on a relative comparison to Treasury bonds. And so that the Fed is by doing that yield curve control, it's another tiger by the tail. We have historical precedent for yield curve control. It's from the late 40s into the mid 50s. And coincidentally, perhaps, the interest rate levels and the inflation level where they set, in the 40s when they were doing it, was kind of the same
as where we are.
As it was before we started doing our yield curve control now. You had short rates at about 3/8. You had, long rates around 2. That's kind of where we are. And so we're doing the same thing. So what happened? Then inflation started to go up, and we had negative real yields back in the 40s and 50s. And they kept doing the yield curve control. And people said, well, this inflation's not good. It's going to be transitory. And there were some inflation bumps in there. And when they stopped the yield curve control, they let go of the tiger's tail. Well, that started a nearly 30-year bear market that took rates from 2% to, on some vehicles, 20%, but on long rates, 14 or 15%. And so that's kind of the setup that we have right now, is that we're set up for that. Now, will they control for 8 years? Maybe. But at some point, you're going to have the collision of all this debt and perhaps a market that won't accept these low interest rates. And that's the thing. People say, well, we don't have to worry about the debt because Japan has more debt to GDP than we do, and they don't have any. Well, that's because their rate is at 0. If you have rates at 0, you can have infinite debt,
right? Which
our policymakers seem to have finally figured out the math of that. 0 times,
anything
100 trillion is
0.
Right. And so it looks fine. And then I was asked a question in an interview I did recently. Someone talked about, modern monetary theory. Who cares about debt to GDP as long as your policies aren't causing inflation? What's wrong with that logic? This fellow asked me, and I said, we have inflation.
We have inflation,
right? It's not like we don't have inflation. And the Fed started out basically taking cover underneath the words temporary and transitory.
Mm-hmm.
And it seemed like temporary and transitory meant the second quarter into like June. So it was going to be 3 months.
They were waiting for those base effects.
Right, the base effects. But
we don't hear much about base effects anymore.
Well, because there aren't any anymore. We're already getting into a comparison of higher numbers. Right? And so then transitory turned into, felt like 6 to 8 months. So they sort of doubled.
One of the Fed district presidents defined it that way, maybe 9 to 12 months.
Yeah, I think now we're talking 9 to 12,
mm-hmm.
and I think it's going to end up going to like 12 to 18, because most people, we have a fairly simplistic inflation model that's been surprisingly accurate for its simplicity. We knew that inflation was going to go above a 4 handle.
Mm-hmm.
And a lot of that had to do with the price of energy going up and expectations of shelter going up.
Yep.
Which
is Fed data.
I'm talking about headline CPI. We didn't see in our model a 5 handle. But now the model continues to believe that we're going to have a 5 handle on year over year CPI headline every month, except maybe year end, where we think it's a coin toss whether it starts with a 4
or 5.
So that's going to be about 8-9 months of transitory, so-called. And so we'll see. But inflation hasn't been transitory, and it doesn't appear that it's going to be. So
you've talked a lot about inflation. You haven't talked any about stagflation, which it's starting to feel like
this feels a lot like Jimmy Carter. And a lot of people started to use that metaphor. I think I was the first one, because we now have what appears to be a potential hostage crisis. We have what looks like elevated inflation that's not going away, mm-hmm. right? And without forever stimulus, we're going to have a downturn in economic activity. Right.
That's why there's a demand cliff.
Everybody has been basically saying we've got this pig in the python, which is the stimulus and lockdowns, but it's all going to go back to the same sized python.
But nobody can
in 2022.
Nobody can tell you how, though.
Right, in 2022. So everybody expects. We had the jump, the effect of the stimulus propping up GDP to a big number in the first quarter. Mm-hmm. And then it's a little lower in the second quarter, and it's supposed to be lower in the third and fourth. And then it's supposed to magically just be 3% real growth in 2022.
In perpetuity.
I just think it's almost mathematically impossible that you could even ramp down the stimulus and not have negative economic growth.
We're already seeing it. I mean, I've been researching this term fiscal thrust, because now the thrust is going backwards.
Yes.
And you're seeing red bars instead of where you saw green bars. And I mean, it's a real depressant in terms of if it's not replaced. And again,
Sure. It's factored into the economy.
And the type of stimulus they're discussing is what, spread out over 8 or 10 years. That's not money injected into checking accounts. It's a different kind of stimulus is even being contemplated.
And then one of the effects of the lockdowns and the inflation clearly has been, especially around here, a rampant increase in homelessness. I don't know if you drove downtown, but you won't recognize it. There's tents everywhere. There's a federal property that's in a very nice area. It's off of Wilshire Boulevard and San Vicente. Mm-hmm. And because it's federal property, there's tents all over it. And I think most of them are veterans.
We've got a similar situation in Austin.
And the homelessness is through the roof. And therefore...
And this is prior to the rental eviction moratorium.
That's right.
Running out.
Right. And crime is just off the charts. Mm-hmm. It's hard to believe that they've made it legal to steal from a store $950 worth of merchandise here. You will not be prosecuted for stealing $950 from a store. You've seen the videos of people just brazenly going in,
Yeah.
filling up a garbage bag and riding their bicycle out of the store, and nobody stops them. So
yeah, you have a similar sensation in New York right now.
We have modern monetary theory in these urban areas going on right now, because you can hit 10 stores a day for $900 a pop. That's $9,000. If you sell it at pennies on the dollar, you're making $1,000 a day tax free. And there are businesses that were set up for well-meaning purposes where they're selling clothing that's never been used that has tags on them. Like it's supposed to be like a secondhand store, so it's, like a Salvation Army.
But it's first.
These are actually for-profit stores, and no questions asked. So you go in, you drop off your garbage bag full of stuff you just pilfered an hour ago, and you're basically just fencing it. So who cares if you get 10 or 20 cents on the dollar if you're able to do thousands of dollars a day. And so these shopkeepers are shutting down. And there's crime in Los Angeles is just off the charts. My security company has recommended, and we've implemented all kinds of things you never would have thought you would do. Like radar, so that you're surveying away from your property because there's so many people that are casing houses. Crime is way up, and that's not a coincidence. All these things are interrelated.
So, if I hear you, and I've seen a similar feeling in a similar scenario in New York. I've been there 5 times.
I've been in New York in over 2 years.
Well, it misses you, but there's an ancillary market here that nobody's really talking about, and that's offices. The ecosystem surrounding offices in metro areas has died. The small businesses, the lunch places.
Oh, that type of thing. Yes. Oh, yes. These closures are very high, and they're not going to reopen.
Mm-mm.
So we've definitely taken out. That's a manifestation. That's part of the hollowing out of the middle. These were
right.
Small business.
These are small business owners, exactly.
And now, with money printing, what's happening to them? They're going down the economic ladder. They're now in sort of a receiving class. So they're at the mercy of these governmental programs.
So with this most recent bout of Delta that is obviously passing, we've seen office occupancy come back down. We're seeing the World Bank, that was the latest one headline to cross. We're seeing all kinds of companies postponing coming back into the office.
Yeah, we're contemplating what to do at DoubleLine. Several months ago, maybe 3 months ago, it looked like, based on the trends, that after Labor Day, it was kind of a common theme. And I'm wondering, we have to do it voluntarily, so it's voluntary for the people. I think the percentage that are going to volunteer to do it is way down from where it would have been 3 months ago. So I think it's pretty clear that, like, we had this management retreat over the last few days. Sort of, it was established in anticipation of back to work.
Yep.
And it was a good event. I mean, it's up in Montecito. It's on the ocean.
Sure.
The weather was perfect. It's, good food. There were not an insignificant number of people that said, "I'm not doing. I'll do it virtually." And I mean, that was like a paid vacation. So,
what does this imply for office properties? There's a lot of big office properties, and there's a lot of big multifamily towers that have been raised to support robust and growing urban centers and full office buildings. But is it possible that we're going to learn how to partially work from home for a while?
Oh, I think it's more than a while. I think in some departments for certain functions, certainly it's already not in the present moment. It's already permanent.
Doesn't that imply that we've got too many offices?
Yes, it does. But think about IT. Like, even before any of this happened, years before this happened, there were plenty of investment management firms that were outsourcing, NAV calculations and back office to lower cost areas.
Mm-hmm.
And that's one of the ways Austin got going.
Yep.
Was that type of stuff. And certainly IT people. I think IT people are more productive, certainly, and lose almost nothing in a work from home situation. It might be literally nothing.
Right.
All they're doing is
if you're talking about the commuting, then they're gaining.
We're getting back that 2.5 hours a day.
Mm-hmm.
Now, I don't begrudge these people if they want to take an hour of that 2.5 hours of savings and go for a walk. That's okay with me.
Sure.
We're still getting
net
productivity, but there's every reason for people like that to continue work from home. And our operational group, there's just not a glitch. Because they're basically working through systems anyway.
Right.
The whole thing is systematized. The thing that is the bugaboo about the work from home is we've hired probably 24 people since we started working from home. I haven't met them.
Right.
I met one of them at our manager conference because he's a manager. It's only for people manage people.
Yep.
And the others, I interviewed a couple virtually. I did meet with one in Buffalo because at the time, COVID was way down.
Right.
He flew to Buffalo from New York City. So I met 2 out of the 24, and it's very difficult to train people on the processes, the culture.
The culture. I mean, that's something that can't be,
to give them further opportunity. It's much more helpful at the office. And of course, collaboration when it comes to spontaneous collaboration, which in investing money across many asset classes and across the world, you have many teams, spontaneous communication and creativity is valuable, very valuable.
Right.
I'll read something. I'll be at my trading desk and I'll read something, and I'll just walk over to the bank loan group, and I say, "Hey,
right." And
so we can talk about it that way. And sure, you can schedule a call on Teams or Zoom. It's not the same.
No, it's not.
It's not the same. And
I think law firms have realized that, and they're almost forcing in some ways their employee bases to come back, even if it's with protocol or mask or whatever. But it's still.
We have the same meetings. We have more meetings now because you have to replace the spontaneity, and you do that by setting up. I would almost say a redundant number of meetings, so that there is that chance. You schedule some time where somebody might have something spontaneous that they thought of to bring to the party.
Mm-hmm.
We didn't used to have an executive committee meeting 5 days a week. We had one like every two weeks.
Right.
Now we have one pretty much every single day. And obviously, since that's a redundant number of meetings, sometimes they're 10 minutes. But then sometimes we'll get like an hour. We have investment committee meetings and macro meetings, which we used to do spontaneously in a certain sense, and then we would have a formal meeting, once a week, and then for certain other subsectors, a really detailed thing once a month. Now it's 4 days a week, the same thing. And the macro meeting, which I just did today, is almost always 2 hours.
Mm-hmm. And
it's really long.
Right.
It's because we have to go through on a systematic basis all this stuff. Our fixed income asset allocation meeting is starting to push 3 hours because we only do that once a month, and it's painful to be on Teams
sure.
for 3 hours. And of course, another negative of the work from home in the Teams or Zoom sort of situation is people can just turn off their camera and go water the lawn if they feel like it.
True.
I started a pretty funny technique. I stumbled across it by accident, and that is one time I forgot to hit the disconnect button, and so I went back and booted it back up like 20 minutes later, and there's still a bunch of faces there, which means they weren't really in the meeting.
Right, exactly.
They were in it because they didn't know it ended.
Right. Wow.
Right? Which is a really good way of kind of stealthily understanding who's contributing and who
That's
isn't.
right.
First of all, they don't say anything. There's people that just don't say anything.
We talked about this last time, that it was a good way of identifying.
Yeah, and actually, and we've had some changes as a consequence of this.
Well, so speak about an outgrowth of that, because not a lot of people are talking about the massive investment that a lot of companies have made in accelerating automation. I mean, this pandemic is, again, you learned which of your employees were productive, which weren't, and you also learned, well, gee, I don't actually need a human being to do this after all.
Yes. Yeah.
And separately, will business travel budgets ever go back to where they were?
Never. There's no way. It's when I think back of what we used to do in the 80s, dating myself, and the 90s, it was insane, the stuff that we would do in terms of business travel. I countless times flew to, say, I remember this is always top of mind for some reason, to Minneapolis for one meeting. Fly to Minneapolis, and the meeting is like 20 minutes. And that was just the way the business worked. You would get a call on, it would happen. It was frequent. You get a call on like a Thursday, and we have a committee meeting. We want you to present in a week.
Yep.
It happened all the time.
But you had to check
over there, so you blow a whole day flying to Minneapolis. Then you got your meeting, and you fly back. That's 2 days that are gone. And we used to have so many people visiting the office, and I don't think even half of them are going to do that anymore, because it doesn't seem that the cost benefit analysis is nuttily opposed to continuing that activity. And so you can definitely do that stuff, and so it'll never come back. We saved. It's interesting how much money you save.
Well, that's the thing. That's my point, is once you automate, once you save money on business and travel, I mean, once you see that go straight to the bottom line, you're never turning those switches back on.
And our management conference, we had, 75 people there or something like this. And it was not low budget. It was like paid vacation at essentially a resort in one of the best locations in the world. And it wasn't cheap. I'll tell you that. I was shocked at how high the hotel rooms are. Talk about inflation. I was shocked. I mean, it was probably triple what I expected. It was unbelievable. And yet, with all of that, it was less than 1 month's cost of business travel in pre-pandemic. Wow. It was less than a month.
That is perspective. That's amazing.
I could not believe how high the rooms were, but it didn't matter. It was basically,
if it's sporadic,
right? And we have just tremendous savings on the travel, and I don't think people really are all that anxious to fly across the country for 2 meetings when there's some efficiencies without it. And I finally did have a client come and we went out to dinner. This was like 3 weeks ago now. It was the first time that had happened since the pandemic started.
Well, it must have been a good dinner.
It was good. This fellow, he's kind of a friend of mine. I call him a client, but we've known each other for 20 years, and so we just like to share reviews and stuff. But it felt weird. It was like, you sort of forget how to order.
Sure. Let's look ahead. Let's look at who's at the table going forward. Janet Yellen has publicly endorsed Jay Powell to be renominated.
Yeah, it's one big happy family.
Is she the right person for her job? Is he the right person for his job? Is Joe Biden the right person for his job?
I think Powell has found kind of his groove to a certain extent. Fed governors, I mean, they always, in the end, they always seem to do the same thing as their predecessors did. I don't really see a lot of change. Janet Yellen, I think as Treasury Secretary, I just don't see it. I don't see the skill set there.
Would she be able to do a not QE? Would she be able to handle a financial plumbing?
She's just going to push the go button. You could just have a computer You just say yes. You just go along with it. That's it. And then, I don't know. The presidency ages people really quickly. Biden already looks substantially older than he did last November.
Mm-hmm.
My theory is that it speeds up your aging clock by a factor of about 4. So in 4 years, they age about 16 years. Maybe it's 3, maybe they age 12 years. But if that's the case, Biden has already aged a couple of years. And, it doesn't look good. I mean, it looks like, I should put it this way. I don't want to get political, but I wish I had a president that didn't have to read crib notes at press conferences.
Mm-hmm.
That's not a big ask.
I like that. You tweeted that out.
It's just not a big ask.
Right. So let's not make it political, but let's take the example of how Afghanistan has been handled. And looking back, again, this is prior to the pandemic, growth in China had slowed to a 30-year low.
Mm-hmm. Not anymore. The U.S. stimulus has been great for China.
Okay, so
the stories about container shipping, that they've gotten to the point where they just ship them back empty.
Well, we've been dead. I mean, from here, from Long Beach, from Los Angeles, they've deadheaded back all these containers, and now China's sitting on all these empty containers. Doesn't that put them in the catbird seat?
When they report import-export prices, which are through the roof,
mm-hmm.
I think I'm told that's a pretty clean measure of inflation, a lot cleaner than CPI with its adjustments. Does that include the cost of shipping it? Do they? Does import prices include the cost of shipping it? I don't know.
I have no idea.
I think it doesn't.
But I don't think it does, no.
I think it doesn't. That means...
No. I know people in the industrial world, and that's a whole separate cost center.
Even though I think export prices year over year are up 37%, that doesn't include, I think, the cost of shipping it. 37%. Mm-hmm. It's just unbelievable. The PPI has gone up on average 1% a month this year. I mean, that's Carter-esque. So anyway, I took you off your point.
Well, but however, no, you didn't, because our response to the pandemic has kind of pulled China out of its morass. Right now, its industrial sector is leading.
What was China's GDP for 2020? I think it was like some crazy number. I think there were quarters in there that were double digit.
Mm-hmm. There were.
So it's the strangest thing, because it's the economic winner in the pandemic is potentially the country that maybe unleashed it. Yep. Whether or not it's intentional, I doubt that.
But we do know that they knew it existed for
it seems like
6 to 8 weeks before they signed the trade agreement. So
yeah.
But more to the point, go back to Afghanistan for a minute. If you're Xi Jinping and you're watching how this is playing out, and you've got your eyes on Taiwan, or not, you have to be in the right position, or not, how do you approach your relationship with the United States, given that 2 years ago you were back-footed, and now you're not?
You're thinking about China?
Mm-hmm.
Well, China sent their people over to Alaska, and you were supposed to have a 5-minute prepared thing, and then you were going to have a dialogue. Mm-hmm. And the Chinese official came in, and I think he went for way more than 5 minutes. And all he did is say, "Who the heck are you to lecture us on human rights, where I can't pick up a newspaper, turn on the TV, and not hear about all of the human rights abuses in the United States?" Mm-hmm. With all of your racism and all of your, white supremacy and all of your, other stuff. Interesting point. And Russia pulled the same thing. And it's obvious to me that we cannot possibly defend Taiwan. I can't see how we could possibly.
That was my question.
I don't think it's possible. First of all, we don't have any money. We don't have any. We haven't built our productive capacity at all.
Mm-hmm.
With this GDP has a lot to do with buying Chinese goods through Amazon.
Sure.
How
And financializing the country.
How is that U.S. GDP?
Right.
How is that GDP when you take all of this? 70% of GDP supposedly is consumption.
Mm-hmm.
If it's just Chinese goods, that consumption is bogus GDP.
Right.
So
And the other effort has gone into financialization as opposed to productive ends.
Yes. So I don't see any way. The other problem that we're having, and again, all these things are interconnected. There's going to be a frightening fall off in enlistments into the military. I'm convinced. People just aren't going to want to enlist because the way that the military has chosen to start, their education programs and all this stuff. Again, another anecdote. I know this guy really well who's from a military family, uncles, father,
Right,
grandfather, and he was going to go into the military. Not anymore, and the people that have historically been enlisting in the military and dying to defend the United States have sort of been the white middle class. Something like 70% of all casualties in the Middle East were the white middle class.
Right.
Now, if you're going to discourage them from enlisting in the military, because those are exactly the same people that don't want this curriculum change. So I'll be agnostic on what I think about the curriculum change, but I know that many of these people who were those that were enlisting and disproportionately dying, way disproportionately dying in the Mideast wars were these people that don't want the curriculum change.
I think they're called the silent majority.
Yeah. So just like police departments are having a really hard time recruiting, that retirements have gone through the roof. I think is it Governor or Mayor Lightfoot over there in Chicago?
What a train wreck.
From cutting the budget to now begging people to join because of the crime changes. Again, all these things are the same issue viewed from a different
lens,
facet of the prism.
So I guess my final question then is, what's the fate of the US dollar?
It's going down. The reason the US dollar has been the world's sole reserve currency forever has to do
100 years.
We're the biggest economy, and we had rule of law that was reliable, which is less reliable now, and we had the biggest military by far.
He who rules the seas.
So, well, we do have by far the most battleships and carriers.
Yes,
but the Chinese economy was projected to be bigger in terms of GDP. Years ago, it was 2050, then it was brought forward to 2040, then 2030. And I think everybody now thinks it's before 2030. And
if the yuan keeps appreciating, 2026.
In terms of their GDP. But their GDP is real GDP.
Right.
It's production. They don't have a deficit on a perpetual basis. They often have a surplus.
And their infrastructure is not crumbling.
They have massive savings. We don't have savings.
Right.
Their infrastructure is brand new. So their economy is going to be very United States economy. It probably already is from a productive capacity. And they have made no bones about their willingness and desire to have the world's largest military, most powerful military, and they have the money to do it.
So where are the China detractors wrong? There's a whole cohort of people in the investment community who are so anti-China's going down, China's going down.
I don't know if they're going down. I mean, ultimately, all empires go down. The Roman Empire fell apart, and one of the signposts of an empire that's in jeopardy is they start employing mercenaries as their army, which we haven't done broadly, but we did it in Afghanistan. And mercenaries, not surprisingly, when it comes time to actually battle, they'll be a mercenary as long as they're getting a check and they feel safe.
Right.
And we've paid them a lot. Once they think that the check is about to dry up and that the battle might be coming, suddenly it's not that attractive anymore. Yep.
And one of the other major contributors to the fall of Rome was income inequality.
Sure. Absolutely.
It was massive at the time. So people used to be able to farm their own land and then they couldn't anymore. And everything was absorbed by that top layer and eventually it came back to haunt them.
When the uber rich, because of wealth inequality, come to a point where their army isn't getting populated, they take all of their uber wealth and they pay mercenaries. And we've started to do that. So China is going to have the biggest military, maybe not as soon as 2026, but the biggest economy by 2030 for sure, the way things are going. And it's more of a real economy, as I said.
Right.
And then, of course, one of the most reliable long-term signposts for the direction of the dollar is the twin deficit. When the twin deficit goes up, the dollar is going to go down. And when the twin deficit is under control, the dollar can be firm or stable. Well, it's obvious that the twin deficit is just beyond any historical context. So the budget deficit alone is truly 20% of GDP. Now, if we continue to do the stimulus, it'll stay there. It was there for the 12 months ending, say, June 30th or so. 20% of GDP. And then the trade deficit, which is one of the reasons why I say the stimulus was good for China, our trade deficit is, after years of largely stability, has gone up by a couple of percentage points.
Started to widen again. Quickly.
So you add them up, and the dollar sort of seems doomed, given the twin deficit situation and the ascendance of China as a military and economic power. So China, again, has made no bones about the fact that they want a seat at the reserve currency table, and they're in a much better position. What would stop them if you have savings, biggest economy, and biggest military? Why aren't you?
And internal productivity.
Why aren't you the global reserve currency? So I think that's really what we talk about. Like, I can't believe, wow, every recession gets worse than the recession before it for the past multiple recessions. Every problem, first, we had a housing bubble problem, right?
And every solution's been every solution we've thrown has been in a non-productive manner.
Right. So global financial crisis, and then the tools keep being pulled out. So we had to bail out. We had to bail out the auto companies, then we had to bail out the banks, and
then we had to bail out the people.
And then we sort of had to bail out people and sort of the Fed.
Yes.
Sort of the Fed. And so I don't know if we're going to bail out the next one. I don't think so, because I don't think we can bail out the dollar.
Right.
And that's why I think is the number one investment theme for true investors. I'm not talking about people who have to report quarterly to institutional clients and answer ridiculous micro questions. I'm talking about people that are investing money for their retirement, and they know they're not going to really make many changes. I think they should be. One of the things that I did, and it felt, when you do something, when you change course on something that you've been steadfast in the same position for like 10 years, it feels really weird to make that allocation.
Sure.
It just feels foreign. And I bought European stocks, sold U.S. stocks to buy European stocks in one of my funds, because I really think you're going to be better off on the currency trends. I'm talking about U.S. dollar-based investments. Plus, their stock markets in Europe in particular have stopped underperforming for over a year now. Emerging markets are still really dicey. Emerging markets are underperformed by a lot. And so if you look at U.S. equity performance versus the world, it looks really strong, but it's only because of emerging markets being weak. It's European stocks have matched U.S. stocks performance now, step for step, virtually, with some day-by-day volatility, but almost step by step for over a year now. And so weirdly, I own European equities, which has a funny feeling, but it's not really working, but it's not working. And I think ultimately that will work out on the dollar translation. And as long as it's not working, it's not even uncomfortable.
Would you own the yuan?
No, I wouldn't. I'd be afraid of some sort of authoritarian
confiscation, something.
Yeah, it's kind of like, I always say, I really don't want to buy real estate in a foreign country,
Mm-hmm.
one that has a history of bad actions, because you don't really own it.
So we'll wind this down. I did see your props for Charlie Watts. I have to say,
that was great.
My favorite drummer. So, and your observation that he made it look seamless. He made it look easy.
Simple. Yeah, his drumming was incredibly. It had a spareness to it, an essence, and he had a weird style. It's where one of the things he did is when we hit the snare drum. Usually, he'd play the snare drum. It's the hi hat.
Yep.
He would not hit the hi hat, babe. He would do that a lot, and it created a breathing space in his drumming, and he was incredibly restrained on all the fills. They would just be and not all that flashy stuff. So they hit the scene contemporaneously. Another great drummer who's really underrated is Ringo Starr. Really underrated, because he created more innovative rhythms and introductions and licks. You can tell from the intro drum thing exactly what Beatles song it is, like She Loves You.
Yep, that's true. I never thought about that.
Right? And there's
but I was raised on the Rolling Stones, not the Beatles, so.
I liked them both.
Well, I mean, what's not to like about them both?
Yeah.
But
Charlie
for me,
Watts was,
yeah.
I couldn't believe when I saw that he was 80. So, how could Charlie Watts outlive Keith Richards?
I know. I mean, how impossible is that? I mean, physiologically, that's just a modern medical miracle.
I guess with all of that, he's sort of embalmed or something.
I think he's had all these transfusions and what have you.
Yeah.
One more thing really quickly, and then I'll ask the final question. NCAA playing college players. The Supreme Court allowing NCAA players to get paid. I mean, where I am in Texas, things are just going nuts. Teams are going left, right, in between. We're changing conferences. Conferences are blowing up. What do you think about this?
I'm kind of in favor of it. I don't have a strong opinion about it. That's not an issue that I follow very closely. But it seems to me that universities should not be allowed to make billions of dollars or millions and millions of dollars off of somebody else's work. So from that perspective, I'm sure we'll have all kinds of ramifications.
We're a nation of free agents now.
Universities do all kinds of stuff. They hire, graduate students are kind of like forced labor.
That's true.
They pay them almost nothing.
Right.
They put them into these classrooms. They teach them at a fraction of what a professor gets. And so, it's funny. People talk about the negatives through history of forced labor and slavery and all that. But when you look at it, it seems to me that every single major power that was dominant in their day, well, a lot of them had forced labor and slavery.
Yep.
And China sort of has forced labor right now. And even capitalism is a cousin of this. Because what is capitalism? You pay people a certain amount of money, and they create for the company more than they're being paid. That just fundamentally has to be the premise. That isn't exactly forced labor, but it's not terribly far removed.
It's a cousin.
Yeah. And so what people don't understand is empires will always have this characteristic. Always. What people don't understand is that the Germany, when they came to lead into World War II, one of their strategies in World War II was basically take people over so you can have forced labor. Right. Because that's how you maximize your productivity versus cost, is you exploit somebody. And it's interesting. People are trained to associate attributes to simply words, nomenclature. When you really look at it, it's always this tension, and it will never go away, between a company, going to the top of its field and sort of what they pay people and who they're exploiting. So you asked me, what did I learn? First question from COVID. That was one of the things that I figured out, what I just talked about, because of COVID.
Well, let's end this on a super, super high note.
All right.
What are the Bills going to do this year?
I think the Bills will win the Super Bowl this year or next year. I don't know about this year. That's the kind of their window. It's so hard in the NFL to keep your team together.
Wait, isn't the Super Bowl? Where's the Super Bowl?
I think
it's here.
Or else it's Vegas. 1 year.
I think 2022 it's SoFi.
SoFi, maybe it's 2023. It's in Vegas. Either way, it's nearby.
Right. True.
So I'm certain the Bills will go to the Super Bowl this year, next year. I would put the probability at 80%. So I shouldn't say certain, but their quarterback keeps getting better. And the thing about the Bills is players want to play there, which is a really big change. That's really
that's half your battle.
It's a really big piece of making it to the top. Because for years, when you're a loser, you don't make the playoffs for 17 years in a row. People go, I was drafted by Buffalo.
Yeah.
Oh, God. But not only people love playing there because the cost of living is still relatively low. Buffalo is one of America's most successful cities right now. It's incredible what's going on there. Yep. It all has to do with the fact that it was in such a bad place that, we'll put it this way. It was in such a great place in 1900, richest city per capita in the country, which creates tremendous building with tremendous architecture. Then it went downhill for decades, and they didn't have enough money to tear them down. By all rights, a lot of these old buildings should have been torn down. There was something called the Continental Building, which was vacant for decades. And I know the guy that bought it, and he bought it for basically zero.
Yep.
And he put the money into it, and it's now a very high-end boutique hotel, and there's tons of this stuff going on. So the city is vibrant. There's people coming in, and now the team's winning, and the fans. Well, everybody knows about the Bills fans.
Yeah.
They're just crazy. I don't like going to games there. People are so they're nuts, So all that's going on, and so that's a really big positive, and the players. People can understand Buffalo is a very, very small place. Everybody knows everybody. Everybody has largely the same experience. In LA, people that live in the Valley have a totally different experience than people who live in the South Bay. But it's not like that. So I'm a huge Bills fan, and I suffered all the way through all those years. And I think they're finally going to win. It really comes down to for this year, and the whole thing turns on their defensive line. Did they make moves that will get a pass rush going? That was kind of their Achilles heel. They were giving the quarterbacks too much time. As we saw in the Super Bowl, the Tampa Bay just had a pass rush, and Mahomes was just flummoxed. He didn't know what to do because he didn't have enough time, and the pass rush was so relentless. I was actually at the Super Bowl. The Bills went to the AFC Championship. And just in case they went to the Super Bowl, I want to make sure I had a ticket because I knew it was going to be curtailed availability of seats. And I figured I could sell it if the Bills don't make it. Well, the Bills didn't make it. They actually got beaten pretty thoroughly in the AFC Championship game. And I couldn't sell. It was just the price just didn't go up. In fact, it was going down, which really surprised me. I thought if Tampa Bay is there, there'd be demand.
Right.
But so I ended up saying, well, what the hell? We'll make lemonade out of lemons. And we went to the Super Bowl. And I got to tell you, it was great because I didn't care who won, which helps out a lot.
Oh, yeah.
Because you feel like you're getting indigestion when your team, it always seems like, your team's underperforming even if they're hanging on to a lead. So I didn't care who won. So I was able to completely analyze the game. And I love doing that. And there were it was a zoo getting in because the infrastructure getting to that stadium isn't very good. But once you were inside, there was no lines because all the concessions were open. It was great. I didn't like having to wear an N15 or an N95.
Yeah, N95,
N95 mask. But it didn't matter that much. And so I had a really good time. But the next time, I hope the Bills will be there.
Okay. Well, we'll meet up in Buffalo next time. After Buffalo's victorious.
What you're going to see, have you ever been to Buffalo?
First time. It will be my first time.
I'll tell you the way it goes. People go to Buffalo and they, without exception, report back, I couldn't believe how good it was.
See?
And I'll tell you why. because the expectations are so low.
On that note, looking forward to Buffalo.
Yep.
Go Bills.
Yep, go Bills.
And thank you for your time.
Thanks, Danielle.
Appreciate it. Well, I hope you enjoyed Jeffrey Gundlach, the sequel. I know I enjoyed getting in another great visit with him. My second excuse to come out to California in the last few years. So happy to be here. If you didn't happen to catch the inaugural Down the Middle, the first interview with Jeffrey, go back, take the time, watch it. You'll enjoy it. And then watch this one next. You'll enjoy both equally. I will see you next time for Down the Middle with DiMartino Booth. Thank you for being here.